Hey everyone, and welcome to today's Explainer. I am so pumped you're tuning in because we are unpacking a topic today that is absolutely critical for your financial future. We are diving into the 2026 Retiree Guide to Navigating IRS Tax Rules. Whether you're already kicking back and enjoying your retirement, or you're just meticulously planning your exit strategy from the workforce right now, understanding the shifting landscape of IRS regulations is completely non-negotiable. We're going to break down the exact rules that every single retiree really needs to have on their radar right now.
So what if I told you that just one single IRS rule could literally cost you thousands of dollars every single year? It's crazy, right? I want you to really think about that for a second. Most of us spend decades, literally decades, working hard, sticking to a budget, and saving up to build this comfortable retirement nest egg. But there's this really dangerous illusion out there that the second you stop working, the tax bill just magically disappears. Well, spoiler alert, it doesn't. Making these unknowing, seemingly tiny mistakes with IRS rules can drastically shrink the income you've worked your entire life to build.
All right, let's jump right into Section 1, the retirement tax reality. Here's the thing. Most retirees just flat out don't know these rules. There's this huge, widespread myth that retirement equals an end to taxes, like the IRS just clocks out when you do and leaves you alone to play golf. Actually, scratch that. The tax code doesn't disappear, it just changes shape. And because so many folks just assume their tax obligations are in the rearview mirror, they walk right into a massive financial blind spot. We really need to zero in on exactly where the IRS is looking when they calculate your retirement taxes.
Okay, consider this your wake-up call. Here are the most common taxable income sources once you retire. We're talking Social Security, your 401k withdrawals, traditional IRAs, pensions, and your standard investments. You know all that money you've been stashing away in your traditional accounts for all those years? Well, that was pre-tax money. The IRS has just been sitting back, waiting patiently for decades to collect their share. Retirement is when they finally come knocking for your hard-earned cash.
Which brings us to Section 2, taxing your Social Security. You know, one of the biggest, absolute most shocking surprises for folks entering retirement is finding out that their Social Security checks, the ones they've been paying into their whole working lives, can actually be taxed. It operates on this sliding scale based on something called your combined income. So as your overall income rises from all those other sources we just talked about, the taxable portion of your Social Security benefit goes up too. It moves through three distinct tiers: 0%, 50%, and 85%.
85%. Up to 85% of your Social Security benefits could end up being taxable. Just let that sink in for a second. Depending on your combined income, only 15% of your benefit might actually be sheltered from taxes. It's a massive hit if you aren't expecting it, and it completely derails the monthly budget of countless retirees who just kind of assumed their government benefits were totally untouchable.
Let's keep moving. Here is Section 3, the RMD penalty trap.
So what exactly is an RMD? It stands for Required Minimum Distribution. Basically, at a certain age, the IRS literally forces you to start pulling money out of your traditional IRAs and 401ks by a very strict deadline every single year. You can't just leave the money sitting in there to grow tax-deferred forever. And guys, here's the trap. If you fail to take these RMDs, you get slapped with a massive IRS penalty. We're talking up to 25% of the amount you were supposed to withdraw. You're heavily fined for basically forgetting to pay yourself. It's brutal.
Okay, rolling right along to Section 4, the Medicare Premium Surprise. Here's a sneaky one. Having a higher income in retirement doesn't just bump you into a higher tax bracket, it can actually trigger some pretty steep Medicare premium surcharges. It's known as IRMAA, or the Income-Related Monthly Adjustment Amount. Get this, earning literally just $1 over a specific threshold can cause your Medicare Part B and Part D premiums to spike significantly for the entire year. It's a hidden tax that catches so many people completely off guard.
All right, take a deep breath. It's not all doom and gloom. Let's get into Section 5, strategies to minimize taxes.
Let's kick this off with one of the absolute best tools in the tax code, the home sale tax rule. Let's just walk through the math here together. Imagine you bought your family home years ago for $200,000. Fast forward to today, you sell it for $700,000. That is an amazing gain of $500,000, but guess what your taxable gain is? Zero. Nothing. How is that possible? Well, qualifying homeowners can exclude massive gains from the sale of their primary residence. The IRS gives you a $250,000 exclusion if you're a single filer and a whopping $500,000 exclusion for married couples. That is a massive chunk of wealth you get to keep totally tax-free if you meet the rules.
Next up, we need to talk about your portfolio, because how you manage it really matters.
See, not all investment income is treated the same by the IRS. If you buy and sell a stock within a year, you get hit with short-term capital gains. Those are taxed just like your ordinary income, which usually means a much higher rate. But if you just hold those investments for longer than a year, you transition over to long-term capital gains. Those max out at 20%, and they can even drop to 0% depending on your tax bracket. The big takeaway here? Simply practicing a little patience and holding your investments longer can drastically lower your tax rates. Timing is quite literally everything.
Now let's look at the accounts themselves, specifically the traditional IRA versus the Roth IRA. As we touched on earlier, traditional IRAs give you a nice tax break up front, but you definitely pay the piper once you retire. A Roth IRA totally flips that script. Yes, you pay taxes on the money before it even goes into the account, but the absolute best part? The growth and eventually the qualified withdrawals you take in retirement are 100% tax-free. A lot of savvy retirees use Roth IRAs to build this highly tax-efficient stream of income that the IRS just cannot touch.
And hey, giving back to your community isn't just good for the soul, right? It turns out it's actually an incredible tax strategy too. By using tools like a qualified charitable distribution or a QCD, you can actually knock out your mandatory RMDs by donating directly to a charity. That means you entirely bypass the income tax hit on that money. So by strategically directing funds to causes you genuinely care about, you satisfy the IRS and you might even drop yourself into a lower tax bracket. You're saving money while doing good. All right, as we round the corner, here is Section 6. Avoid these costly mistakes.
Let's just quickly rattle off these major red flags so you know exactly what to dodge. Number 1, missing your RMDs. Seriously, do not pay those 25% penalties. Number 2, ignoring your Social Security taxes and getting totally blindsided come tax time. 3, selling investments without a plan and triggering those massive short-term capital gains. 4, forgetting about the Medicare impacts of a high-income year. And 5, waiting until the end of the year to start your tax planning. Guys, if you're waiting until December to figure this all out, it's already way too late to use most of the best strategies.
So how do we prevent that horrible last-minute panic? Well, here is a proactive end-of-year checklist. Honestly, every single retiree should be reviewing these 6 steps well before the year wraps up. 1. Check your Social Security taxation levels. 2. Verify your RMD status and make sure those withdrawals are locked in. 3. Review your investment gains. Decide what to hold and what to sell. 4. Calculate your estimated income so you can anticipate any of those Medicare premium surcharges. 5. Factor in any plans you have to sell your home. And finally, step 6. Talk to a tax professional to make sure your personalized strategy is absolutely airtight.
You know the old saying, knowledge saves money? Well, that pretty much hits the nail on the head for our whole explainer today. Retirement taxes are incredibly complex, kind of like a giant puzzle, and ignoring them is a luxury you really can't afford. But understanding these 2026 IRS rules, that empowers you. It helps you keep significantly more of your hard-earned money right in your own pocket, and it ensures you entirely avoid those deeply frustrating, costly surprises.
Which brings us to our final thought. The earlier you start planning, the greater your opportunities are going to be to optimize your wealth. So, are you prepared to protect your retirement this year? Don't just sit back and let the IRS dictate your retirement lifestyle by default. Take these insights, use that checklist, and start making informed financial decisions right now. Thanks so much for hanging out with me for this explainer. Keep learning, and I will see you next time.